Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I want to talk about the AI trade and relate it to what we can learn from the dot-com bubble that occurred in the early 2000s. The AI trade is really just shorthand for investing in a way that's going to capture the productive value and growth and returns that might be expected from advancements in AI. And of course, we can talk about the Magnificent Seven companies, which all are taking advantage of AI, which are the large cap tech companies in the US, ones like Nvidia and Google, Amazon, all these kind of guys. You might think that they're going to be the winners because they're such mega cap companies, multi-trillion dollar companies. Microsoft's nearly close to $4 trillion. They're closer to $3 trillion today. Well, I think we can learn something from the dot-com bubble. And unfortunately, I'm old enough to remember that and what happened there. So I thought it was a good exercise to go back and ask ourselves what happened then, what drove returns in the dot-com bubble, and how did it all work out for investors in the long run. Now, let's talk about the AI trade. The AI trade can be as concentrated as targeting companies that are in the AI space. And there's some businesses called native AI businesses, which are really businesses that enter into an industry purely from an AI perspective. Like they start as AI businesses and then build a product around AI for a given industry. So it can be as tight as that. It can be wider to looking at, data centers, chip makers, all these sorts of businesses, even going further down, power infrastructure, copper, critical materials, these sorts of things. And really the investment tends to sort of split into kind of two questions. Which companies are most likely to benefit from the AI adoption? And how am I going to identify those companies? And then second, which companies are likely to be disrupted by AI, where AI will cannibalize their product or service? And how do we spot those risks, I guess, in the market? And it's that second question that's been, I guess, more topical over recent weeks. And there's been talk about, how AI might disrupt, for example, in Australia, the REA Group, which runs the realestate.com.au website. So as I said at the beginning, I'm old enough to remember the dot-com bubble, and maybe that's fortunate for listeners and unfortunate for me, but it really started kind of mid-80s. A lot of people would say, started probably the first internet company was Netscape. It had an IPO in 1995. So, we're talking 30 years ago, and it's often been cited as kind of the first internet business, if you like. Netscape was a web browser product, much like Google Chrome or something like that. And that's really where the excitement around the internet began. And the whole excitement around the internet was, of course, it would transform existing businesses. It would create new ones. It'd potentially allow existing business to scale faster because now they had a global reach. And that was all right, of course, except the market got a little bit ahead of itself. And instead of focusing on business fundamentals like cash flow and profitability and these sorts of old-fashioned metrics, they started to focus on website traffic, number of eyeballs a website would attract, and even got as far as just buying into a story about a particular product that could be on the internet one day. And by early 2000, the bubble had pretty much reached its peak. So it occurred, the bubble burst in 2000. And, I saw it firsthand because at the time, it was only just a few years before I started Pro Solution. At the time, I was working at Deloitte in corporate finance doing business valuations, company valuations. And those valuations became, particularly in this dot-com sort of sector, became completely disconnected from economic reality. And we saw some businesses either attract venture capital or list on exchanges, so IPO, that were pre-revenue. So that is, they didn't have any revenue. It was probably nothing more than an idea at the time. And it didn't make sense back in 2000. And it's not going to make sense today as well. Fundamentals are in fact fundamental. And I think there's some good parallels with what's going on today with the AI trade, because really what investors were trying to do is work out how this powerful new technology would ultimately translate into economic value. And at that stage, it was all about the internet and connecting the world together on the internet, and the information flow that would result of people connecting on the internet. And with AI, the conversation at the moment is really around, productivity enhancements, better outcomes, whether it's going to cannibalize human jobs, whether some jobs today will be done completely by AI in the future. So, whilst we're talking about two different technologies here, the parallels are the same. So what I did then is had a look at, well, who were these market darlings on share markets back in early 2000? So much like you talk about, for example, Nvidia today, Tesla, some of these market darlings that everyone gets very excited about. Who were they back in 2000 and how did it all work out? And so what I did is identified the most valuable global technology companies back then, and six of them, were in the top 10 of the most valuable companies in the world as at the beginning of 2000. And then I had a look at their peak market capitalization. Market capitalization is just another way of expressing how much was the company worth. And that market capitalization would have peaked for most of these companies in the first half of 2000. So whilst I looked at their global ranking at the beginning of that particular year, their share price might have peaked, might have been in March, might have been in June, but sometime pretty close to that. And the reason why I wanted to mention that is just to show that I'm not cherry picking these companies. So I truly looked at who were the most valuable companies in the world at that particular stage. How were people getting excited about it as a result of what they used to call the information age, the internet's revolution, the dot-com bubble, if you like. And then I had a look at, well, where are those companies today? And, this is just an important lesson in history, I think. And, I talk a lot about making evidence-based financial decisions. Well, who could have thought, for example, that Google, which has become part of our vernacular, or we'll Google it, who would have thought Google could have been knocked out of the internet search race? I mean, if you had said that to me, say, even as recent as 3 years ago, I'd say they've got too much of a market share. Too many people use Google. How could it ever happen? But now I think with AI, it's conceivable that, Google, in its previous form as a search engine can continue to exist or at least thrive as it has in the past. I mean, I know myself, I don't use Google that much anymore. Anyway, let's get back to the track record because it's really interesting. Okay, the number one global business at early 2000 was a technology company called Microsoft. Its peak market cap in 2000 was $600 billion. Microsoft is worth around about north of $3 trillion today. So, they're a winner. In fact, they're the only winner I'm going to talk about. Now, the rest are losers, and you won't recognize some of these names. They're still around, but not in the same format as they were previously, because a lot of these were in the top 10 most valuable businesses in the world. So Cisco Systems is second on the list. They were worth $555 billion in 2000. They're worth $330 billion today, so lost about 40% of their market cap over the last 26 years. Intel was worth half a trillion. It's now worth $250 billion, so lost half of its value over the last 25 years. Nippon Telegraph and Telephone, a Japanese company, of course, $270 billion, now worth $80 billion. Lucent Technologies, $260 billion down to $13 billion before it was merged with Alcatel. Nokia, if anyone's old enough to remember Nokia phones, it used to dominate the handset market, was in 2000 worth $300 billion. It's worth $39 billion, so almost 1/10 of its value. AOL, America Online, that business was worth $222 billion. In 2025, it sold for $4.4 billion. And Yahoo, it was worth $125 billion, and it ended up selling for $4.8 billion in 2017. So here I've got 8 very valuable companies back in 2000, and all failed except Microsoft. Now, I should say Cisco Systems, for example, was around about that time, people were writing it's going to be the first $1 trillion company there ever was. Remember, it's worth about a third of $1 trillion today. So, we'll all look at Apple, we look at Nvidia, we look at Tesla, we look at Amazon, Alphabet, which is Google, Facebook. We look at these companies and think Microsoft, we look at these companies and think, how could they ever not dominate? Well, history tells us in the last technology cycle, for example, many of them won't be around, at least not in their same sort of format, or lose a lot of value over the next couple of decades. Now, Microsoft was the clear winner there, and they pivoted really to go into cloud and AI. Their pivot from a software product to a subscription product was the thing that sort of saved that business, of course. So some will pivot and some will survive, but many won't. The Australian share market had very similar experiences in the dot-com era. So only those that probably the same age as me or older will remember companies like OneTel, DavNet, Solution 6, eCorp, and the REE Group. And except for the REE Group, which is the realestate.com.au, all those companies failed to deliver long-term value. So the same outcomes, they all sort of disappeared, wound up, got purchased, and no investors in those business in the long run would have made any money. Now, I'm positive on AI, by the way, I should say. So I think AI is probably going to be the biggest technology advancement in my lifetime. And remember, when I started work, email did not exist, and nor did the internet. I, I feel so old saying that. Now, I hope it doesn't come across as like hyperbole for me to say I think it's going to be the biggest thing in our life, but I really actually think it will be so significant. So whilst I'm confident on that, I'm also confident on the fact that the most likely winners out of AI might not even exist yet. So the companies that are going to be the large tech companies and the ones that harness all the value might not actually exist. Yes, in fact, the technology that might end up, surviving might not even exist yet. I mean, they say that large language models like ChatGPT, for example, tend to get twice as powerful every 7 months. So the advancements in this space are huge, and it's really difficult to understand what technology is going to work. For example, everyone gets very excited about NVIDIA and its chip and how powerful its chip is and so forth. And I understand that it's built in architecture, so it's sort of ring-fenced its customers in. But the reality is if someone invents something that is better than what NVIDIA is producing and cheaper and more powerful, it doesn't take long for that economic value to shift, because AI companies are investing ridiculous amounts in trying to achieve some scale in infrastructure and so forth. And so if someone comes up with a cheaper solution there, the savings will be significant. And if they do that, NVIDIA could go to zero. I'm not saying it will, it's worth $4 trillion today, but what I'm saying is it's very hard to pick the winners at the beginning of the cycle, and there's a lot of water that can go under the bridge. The other thing too, you've got to be mindful of, you don't necessarily have to pick the AI winners, because AI will most likely help a lot of industries, healthcare, finance, logistics, manufacturing. And it's quite possible that some of these industries and some of the companies that exist in these industries might be able to extract even more value than what the AI companies are extracting themselves. So I think that AI play is a global share market phenomenon, not just a technology one. And I don't think we can understate the impact on productivity and scale and revenue per staff member and all the metrics that could be greatly improved as a result of AI. And I'm not by no means saying that, look, everyone's going to benefit. Of course, there's going to be winners and losers. What I'm saying is it's possible that you'll find a fintech company, for example, so that's in the financial industry, that could use AI to its advantage to become a very profitable and economically powerful company. And just by having broad index exposure to share markets, you already have both direct and indirect exposure to the AI trade if it was. So really looking back at what happened in the dot-com boom is a useful reminder that The large tech companies that are dominating the market and have dominated the market for the last 10 years, many of them probably won't dominate the market for the next 20 years. But it's impossible to work out which ones are going to survive and which ones are not going to survive. But that conclusion fits nicely with our evidence-based investing approach towards both investing in shares and property in all asset classes. That is index investing. The basic logic is very simple. And the logic is that it's very hard, if not impossible, to consistently pick the sectors or companies that are going to deliver the best returns over the next few months or next few years. It's even harder to know when to sell those winners, and then harder again to consistently pick the next pile of winners or the next parcel of winners, if you like. A more realistic conclusion, evidence-based conclusion, is to just use a rules-based approach and use a rules-based approach to spread your money across a broad basket of companies and let the competitive market sort out the winners from the losers. And the market will sort it out. You don't need to. So here's a really good example. Think about CBA, Commonwealth Bank. Over the course of 2025, CBA's share price peaked at about $190 per share. And at the time when it was getting close to that peak, which is kind of mid-2025, there was a lot of commentators out there that were on podcasts saying it's all index funds. A lot of people are putting money into ETFs, and now that CBA makes up 10% of the share market, there's a lot of buying by index funds, and that's what's pushing the price higher, it's nonsense. And we spoke to Vanguard directly and their portfolio managers, said, what do you think? And they said, look, if it's a large cap stock like CBA that makes up 10% of the market, it just depends on what's happening on that particular day, but the trading's not going to be more than 5% of 5% of total trades in one day. So 95% of the market is made up of active traders. So that could be hedge funds, institutions, high frequency traders, super funds, everyday investors. They're the active element. That's 95% of the market. And at worst, a Vanguard or a Beta shares, all them together, less than 5%. On most days, it's closer to 1 to 2%. And so they're not the ones. Index funds aren't moving the price because all they're doing is buying the market proportionally. They're not saying CBA is better than ANZ. They're just saying I'm buying in the proportions that you've already told me that what they think they're worth. So they're not creating any extra demand for ANZ, for example, relative to CBA. And the best example of this is that CBA share price, as I record it today, which is the 10th of February, is around about $160. So remember I said mid last year it was $190. Now, so what has contributed to that decline? Is it the index funds? Because those index funds would have been attracting just as much to the market as they were mid last year as they are today. Those flows haven't changed, but the share price has come down. And that's the best evidence to demonstrate that index funds don't move markets, active traders move markets. And that price discovery mechanism, the fact that prices and buyers and sellers are constantly negotiating in real time. So you've got hedge funds fighting over stocks as either sellers or buyers, and they're finding a midpoint where they agree in terms of a price. That price discovery mechanism is incredibly important because what it's doing is it's reflecting all of publicly available information about that particular sector, company, stock, management, projections that management put out, all these sorts of things. It's reflecting everything all in one share price. So as evidence-based investors, we don't need to play the game of buying and selling because 95 or more than 95% of traders are already doing that hard work for us, and they will end up working out. So at the end of the day, the share market, the index will work out how I should invest my money to expose it to the benefits of artificial intelligence. It'll work out when Nvidia is no longer going to be the winner, no longer going to be, one of the most valuable companies in the world. I don't need to do it. I'm just along for the ride as an index investor. Now, I can use different index methodologies, of course, try and protect myself from, if I perceive that there's heightened risks in a particular market or geographical market, which I've spoken about before. And that's episode 313, in fact, if anyone wants to go and refresh themselves where I talked about the 4 index methodologies. methodologies in addition to market cap weighting. So that's the only decision I need to make. Which index methodology suits the exposure that I'm looking to create within my portfolio? The only other question then is, what combination of exposures, that's portfolio construction, do I want to in order to be able to capture the broad-based market? And I spoke about that in episode 380 if you want to go back and have a listen there as well. So there you go. I just wanted to share my thoughts, evidence-based approach in terms of the AI trade. And for any investors out there thinking that they want to be quite bullish about artificial intelligence and sort of capture the potential future returns, that sounds like a good idea, but it's difficult to do in practice. And the best outcome is just to take a long-term approach, an evidence-based long-term approach, rather than swing for the fences and try and pick the winners, and then also have to be in a situation where you've got to pick when that winner will stop being a winner and switch out of that stock. Okay, what I'd like to do now is just talk about the CGT discount Senate inquiry that is going on at the moment. As we've had a couple of questions from people on YouTube and clients and so forth. And so just to fill you in, what's happening is they've established a Senate committee and they're investigating or analysing whether the 50% capital gains tax discount should be reduced. The Senate committee was established by the Greens with the coalition support back in November 2025, and it's due to deliver its report on the 17th of March, so in about a month's time. The premise behind the idea is that the 50% CGT discount is too costly. It's too generous. And they estimate that it costs the government around $20 billion a year. CGT, depending on the year, tends to raise around 15 to 25 billion. And the Greens have said the top 10% of taxpayers receive 80% of the CGT discount benefit. Or another way of saying it, like I would say it, the top 10% of taxpayers are paying 80% of the CGT liabilities. So, of course, they're going to get the benefit because they're the ones that are paying all the tax. And the top 10% of taxpayers pay around about 55% of all income tax as well. So, of course, they're going to get some benefit. The discount was introduced in September 1999 by the Howard government, and it replaced indexation. So what you used to have to do is index the cost base to CPI to work out your capital gain. They thought they'd cut a little bit of red tape, also try to promote, investment in Australia, and so just gave everyone that held the asset for more than 12 months 50% discount. So the Greens are trying to attack that, and they're, as I understand it, trying to attack it for property only, not really for shares. And the idea or their rationale is that it pushes property prices up. There is even Treasury agrees there's no evidence that it's doing that, or if it is contributing to property price increases, it's doing it at the margins like 1 or 2% at worst. So anyway, I just wanted to talk a little bit about that and what are the potential outcomes. Well, firstly, it is probable that they'll grandfather any changes in CGT. I'm not saying they definitely will, but it's most likely. That's what they've tended to do when the government's changed or moved some goalposts around these sorts of things. So I guess that means that there's a good chance that anyone that has pre-existing investment properties will still be entitled to the 50% capital gains tax discount. If they do bring in a reduction of discount, the Greens are going for 25%. I reckon that'd be pretty aggressive. I've done some numbers and compared it to the old CPI method, and about a 40% discount seems to be relatively in line with what the old CPI method used to be. And I think that's the fair method, because what it's trying to do is look at index the cost base relative to inflation, because it's saying in real terms, that's what the value of that asset would be today, and we're just taxing you on any growth that exceeded inflation. To me, that seems reasonable. So I guess if people are attacking the CGT discount saying it's too generous, I think the answer is yeah, it probably is on the generous side, and bringing it back to maybe 40% might be a good idea. I think maybe they should look at staging it, or maybe even saying if you buy a property and that is a rental property for 10 consecutive years, for instance, so you're really adding to the permanent stock of rental in Australia, then you can get your 50% discount. But if you don't do that, then maybe you pay a little bit more CGT, because ultimately what we're trying to do is, I would think, is to attract more private landlords in Australia. If you don't, you've got 30% 30% of Australians are renters. Not all of them can or want to buy a home themselves. There's always going to be a large cohort of renters. And if you reduce the supply of private investors in a market, we know rent's just going to climb. So actually that does more harm to people that are typically, not always, but typically not in a strong financial position or as strong financial position, so they can least afford those rental increases. If we do see a reduction of the CGT discount, well, there's a couple of things that we could consider as investors. The first one would be potentially owning property in a company. So episode 350, which I recorded April last year, I talked about, potentially using a company to own property, still get negative gearing. And the benefit is, although the company doesn't get any CGT discount, it only pays a flat rate of 30% and you get a credit for the tax paid. And so you can then drip feed those dividends out, essentially spreading the capital gain over many years rather than getting in 1 year. And I estimated that then your effective tax rate ends up being around about 14% if you did that, which is better than even what it is in personal name with the discount. The only challenge with doing that in a company might be lending, as in borrowings, because businesses or banks have tightened that up a little bit, but it's still available, still doable, and doesn't necessarily give rise to higher costs, just a little bit more finicky to do that. So thinking about the structure and not necessarily doing it in personal name could be an answer. The other thing we'd need to think about as investors is to say, well, if the tax regime for property is more onerous than shares, then really property needs to achieve a much higher return than what shares does. And so either then you've got to really focus on capital growth, because what you want is a lot higher capital growth rate to offset the higher tax that you're going to have to pay now to justify the investment, or it might put shares in favor. And, one of the benefits of global shares is that they tend to generate a lot more growth than income. So they're still quite good from a, income versus growth split, which is attractive from a taxation perspective to people that are still working. But I think what it does do is it might push more people into the share market and fewer people into the property market. It's just not a good policy to have, different taxation arrangements for different asset classes. We've never had that in Australia, at least not, I can't think of a situation where that exists, because even you can negatively gear shares just as much as you can negatively gear property. So I think they both should be treated the same. But we'll find out on the 17th of March. I'll be on the Australians Money Puzzle podcast that week, and James Kirby and I will be talking about that legislation. And depending on what we get in terms of outcomes, we won't necessarily know on the 17th. We'll only know about the recommendations, and we won't necessarily know what the government will do at that time. But you have no doubt that I'll take the opportunity to write about it when we've got some firm ideas about what the government wants to do about that. Anyway, I just wanted to mention it at the end of today's podcast because I know it's quite topical at the moment. We'll hear a lot about it over the coming weeks, and don't worry about it. You just need to listen to this podcast. I'll keep you up to date with what might happen, what might change, and my thinking around it. At the end of today's show, I'm going to talk about Wealth by Design, my new book. So I'll leave it there. Until next week, bye for now. Now, before you go, one last thing. My new book is called Wealth by Design. It's not a reprint of Investopoly. It's a complete and absolute rewrite based on what I've refined over the last 8 years. If you'd like to be notified the day pre-orders open and receive my pre-order bonus, register your email right now at investopoly.com.au/book. The bonus is a Investopoly research assistant. That's an AI tool that's trained on more than 500 of my blogs that I've written over the past decade. So you can ask it a question and it'll take you to the most relevant ideas and framework. And I'll keep feeding it all my future blogs too, so it'll become a tool you can use ongoing. Again, register at investopoly.com.au/book. Thanks for listening. I appreciate your time.